Welcome, this is Richard. Today we're going to take a look at a comparison between the return on equity and the income statement and the cash return on invested capital that we get out of the cash flow statement. Now, we're taking a look at these two metrics because the pros watch these two metrics. Now, obviously, they look at metrics out of the income statement, but all the pros are using this analysis that's on our website to look what's going on in the cash flow statement. So we're going to take a look at a company A, company B, which one would you buy kind of thing. So let me give you the first example. Here, this construction engineer, we have 28 recommendations in this industry. And right now, this company A is ranked number 3 in the industry. Company B is ranked number 21. Believe it or not, there's 7 companies worse than company B in this industry. But as you can see, the blue line is net income, return on equity, and this is the owner's earnings out of the cash flow statement. Now, company A is significantly more profitable than probably what the street sees. And company B, there's hardly a reason I would ever buy this. In pharma here, company A has great owner's earnings, and notice that there's a negative return on equity here, and the stock is outperforming the S&P. Now, company B, again, this is almost like a zombie company. There's no cash flow from its core business. It's hard to justify why anyone would own company B. Both in the same industry, both priced very close to one another relative to the S&P. Very surprising, but the inside look on the cash flow statement is a completely different story. Next, another bio industry, company A. It doesn't get any better than this. They have big return on equity, and their owner's earnings is outstanding. And again, there's another, and I picked these out because these are both pretty close performing to the S&P. And company B, this core operations is like a zombie company. And here again on department stores, company A is right now more profitable than what the street thinks. Now, company B, now here's interesting. Company B is showing big earnings, big return on equity, and big net income, but owner's earnings is negative. And company B is very bearish. The street's very bearish on it, even though they're showing all these great net income kind of figures. And again, here's another industry, and company A, the street is pretty neutral on this company, by the way, and we're very positive on it. And again, looking at company B down here, has net income, no cash flow from operations. Here again, we go with pharmaceuticals. Here's a company that is very bullish in the street. And here's company B is also very bullish in the street. And it looks like investors are responding to this net income figure, but the owner's earnings is not there. So we wouldn't be that positive on that company here. So, and again, the pros are watching both of these metrics, not just one. And we have both of these metrics on our website. And if you're not looking at these metrics out of the cash flow statement, please join us. I think we can help you. Then here, this doesn't get any better than that. Even though the earnings, the return on equity is coming down a little bit, the owner's earnings are going straight up, and the price of the stock is going straight up. Company B, here again, you're showing positive net income. It's coming down quite a bit. And this company B is Deere. I'll just tell you this, Deere. If you own Deere, there's 26 companies in this industry that we follow. Deere's ranked 21. So there's 20 companies in this industry that's doing better for their shareholders than Deere. Now everybody's bearish on Deere, but I don't think that picture's getting any better. This is something that we're not trying to figure out why Deere is not doing as well. It does not meet our cash flow profile. It doesn't get through the window that our criteria. If it doesn't have positive owner's earnings, bringing value added to the shareholders, we go to the next company. Here is IT services. Now, this is kind of interesting. There's 57 companies that we follow in this industry. This company is ranked 7 out of 57. That means there's 6 companies doing better than this company. And this company looks like they're doing pretty good to me. And of course, this company B is another company, but again, it is performing okay. It's not just getting wiped out. But again, I just wanted to show you what the pros are looking at. Pros are 80% of the market nowadays, the institutional level. And if they're looking at it, I think that you guys ought to be looking at it because I think it'll help you. Anyway, that's it for today. Remember, buy the good ones, and thank you for watching.